Rental income, ROI, appreciation, leverage. Real estate investing has a way of sounding like a treasure map, right up until you read the fine print.
That's exactly the territory Veronetta covers in a recent post from North Alabama Real Estate, the mechanics of building wealth through rental property, and why the math is rarely as clean as the brochure suggests.
Let's start with what rental income actually costs you to earn.
The post opens with a useful reframe. Real estate investing is widely promoted as a reliable wealth builder, but the reality is more layered than beginners expect. Rental income, ROI, and appreciation each carry their own variables and risks.
And the post is direct about what that means for the passive income pitch. The setup is that rental income looks clean on paper until you run the actual numbers.
Right. Here's how the post puts it. A property may generate strong monthly rent, but after subtracting taxes, insurance, maintenance, management fees, and mortgage payments, the actual return may be much lower than expected.
So the gap between gross rent and net cash flow is where a lot of first-time investors get surprised. The number on the lease is not the number that lands in your account.
The post works through the variables one by one. Location drives tenant demand. Properties near employment hubs, schools, and transit corridors hold occupancy more consistently. Vacancy rates matter more than most beginners budget for, because even a short gap between tenants can meaningfully reduce annual returns.
And maintenance is the one that quietly eats portfolios. Older properties come cheaper at purchase, but carry higher upkeep costs. HVAC, plumbing, roofing, and skipping that line in your projections is how a profitable investment becomes a burden.
The post also addresses leverage carefully. Borrowed capital amplifies gains when values rise, but debt obligations don't pause when rental income drops or the market softens. The framing is that leverage works in both directions.
Which is the part the treasure map usually leaves off.
There's also a section on loan paydown as a wealth mechanism. As tenants cover rent, a portion of the mortgage retires, building equity steadily. The post calls it a forced savings mechanism that distinguishes real estate from most other asset classes.
Patience and consistency are the actual strategy here, not timing the market perfectly or finding a single windfall property.
The post closes on that note, that the most durable investors treat real estate as a business, not a shortcut, and that long-term wealth comes from rental income, appreciation, loan paydown, and tax advantages, working together over time.
The through line here is that real estate rewards the people who do the unglamorous work, running the numbers, planning for vacancies, respecting the dead.
More on what that looks like in specific Huntsville neighborhoods next time.